Welcome to Smoke and Mirrors, the podcast that cuts through the noise of the many policies and regulations that affect American agriculture. Each week, we pull back the curtain on the programs, policies, and perceptions shaping the agricultural community in rural America. If you've ever felt like something doesn't add up, you're not alone. I'm Genevieve, and this is Smoke and Mirrors. Let's make sense of the maze we call farm policy. This is Jenny Ift. Welcome to Smoke and Mirrors, the podcast where we make sense of agricultural policy. We're here today to talk about financial regulation, and I'm excited to have Ty Kreitman of the Kansas City Federal Reserve Bank Omaha branch. Ty, can you introduce yourself?
Of course. Good morning, Jenny, and thanks for having me on the podcast. My name is Ty Kreitman. I'm an associate economist at the Federal Reserve Bank of Kansas City. Jenny mentioned I'm based out of our Omaha branch office. So in my role, I support our efforts related to the agricultural economy. So my job is equal parts research and analysis related to agriculture and outreach related to agriculture. So we spend a lot of time trying to better understand conditions in the agricultural economy and try to incorporate that into our monetary policy making process, and just as a way to help inform the public about conditions in agriculture. I probably focus more specifically on topics related to agricultural finance and agricultural banking. I've been with the Kansas City Fed for a decade now, so I just came up on my 10-year anniversary this year. And I started my time with the Kansas City Fed on the bank regulation side of what the Fed does. So I was a bank examiner at the Federal Reserve Bank of Kansas City for about 4 years, and then I transitioned to my current position on our economic research and outreach side of what we do in 2018. So I have a lens through the Fed's regulation function, but then also the Fed's monetary policy function.
I think you're the perfect person to talk to. And what I want to do today is really dive into financial regulation. Is it important? Why does it matter? And I think, if you don't have good financial regulation, a lot can go wrong. It might sound boring or scary, depending on what your perspective is, but I do think it plays an important role in today's economy in general and in agriculture. But to start off, what's the Federal Reserve Bank and why does it exist?
Of course. And I would have to agree. I am a part of a financial regulator, so I think financial regulation is a very important part of our economy. So I might describe a little bit about what the Federal Reserve is. So the Federal Reserve is the central bank of the United States. We often describe the Federal Reserve in the United States as a quasi-government entity. So we say that because there is two distinct structures, or two distinct entities, I would say, within the Federal Reserve System that make up the Federal Reserve. And those are the Board of Governors based in Washington, D.C., which is a government agency. And then the other portion of the Fed are the 12 regional reserve banks, which have their own Board of Governors and sort of operate independently from one another with oversight from the Board of Governors in Washington, D.C. So it's those two elements that come together to create what we call a quasi-government entity with the Federal Reserve. And the purpose of the Federal Reserve falls under a few functions. So one function that most people are probably keenly familiar with is monetary policy. Another function is financial regulation of banks and depository institutions and other types of entities. And then another function of the Fed is promoting efficient and stable payment systems. And then finally, the Fed also does some work with consumer protection and community development in low to moderate income communities. So the Fed actually has a lot of different functions, and it's a very big system. We call it the Federal Reserve System, has a lot of different functions. It touches every part of the country. And ultimately, all of those things come together to achieve what the Federal Reserve really is meant to do, which is promote financial and economic stability and help the economy grow in a healthy way.
And I guess let's back up even more. When I give a lecture on finance and finance policy in my agricultural policy class. And the first question I ask my students is, why is finance important in agriculture and in general? And, they usually say, well, you need credit to farm. And I say, okay, why? And part of it is because you're making big investments and you don't get paid until later. The other part, and usually I have to bring this up, is that if somebody doesn't have a lot of savings, doesn't come from money, basically, you can use credit to build a business and get ahead. Is there anything else you'd add to that?
Yeah, I think I would also add that credit in general is an important part of modern economies. It's basically it's an essential tool that all types of businesses and households and individuals use to help them complete transactions. It could be for a number of reasons, like you mentioned. Maybe you don't have the capital, you don't have the cash to make some sort of purchase that you need to make to better your life or to expand your business. But credit could also just be used as a tool to leverage someone having cash that needs to make money off of it and someone not having cash to help the economy grow. So credit is just an essential tool of our modern economy. And it really, if used correctly, it's a really powerful force to create economic growth.
Absolutely. All right, so let's dig in a little bit. We talked about, so first of all, the Federal Reserve Bank, there are regional branches. So the Kansas City Federal Reserve Bank has several branches. And so the focus is mostly regional, and does monetary policy happen more in DC?
So I would describe it as this, Jenny. I would say that, like I mentioned, so there's the Board of Governors and then the 12 regional reserve banks. And you mentioned all of those 12 regional reserve banks, most of them have a network of branches in their individual districts, which are geographic. And so for our district here in Kansas City, we represent a 7-state region in the middle of the country. And then we have 3 branches that basically help us connect to the local communities. So we have a branch in Omaha, a branch in Denver, and a branch in Oklahoma City. And we tend to think of those branches as those individual areas' connection to the central bank. And we call it a connection because we, on a regular basis, through our boards of directors of those individual branches and our outreach efforts in our districts and in the individual states that we represent, we're taking all of that information to help inform us so that we can inform our president and they can go to what we call the Federal Open Market Committee, which is a combination of the boards of governors and the presidents of the reserve banks. They all come together to decide monetary policy. So it's that individual branch and then individual connection to local communities that's connected up through our process for informing our president and then taking that informed approach and perspective to Washington, D.C. to help make sure that all types of perspectives are incorporated.
So you have sort of regional responsibilities, but monetary policy is being informed by what happens across the country through these branches.
Correct. Yes, exactly.
And it's something I studied, but you don't get into the details much. So this is great. All right, so let's dig in a little bit, I guess, to financial regulation. What exactly is financial regulation?
Sure. So when I tend to take one step back before I talk about regulation, and I like to think the distinction between laws and regulation. So both are rules, both are sets of rules. Laws are typically broader sets of rules that are established by some sort of legislative body, so either national or state. And then regulation is the tool that we use or the rules that we use to implement and enforce laws, typically at a more refined level, at a more disaggregated level, maybe specific industries or specific areas of the economy. And so when we think about that sort of laws, regulation broadly, financial regulation, I would describe as the system of rules and policies and enforcement in the United States that helps govern all types of financial institutions. So think banks as depository institutions, but also a variety of different financial mechanisms that exist in the economy. So think markets and trading, all of these things. So there are actually a number of primary financial regulators in the United States that focus on different areas. So the Federal Reserve is one of those. Also in the realm of bank regulation is the FDIC, Federal Deposit Insurance Corporation, the Office of the Comptroller of the Currency, the OCC. But then there are other financial regulators. Think the Securities and Exchange Commission, the CFTC, the CFPB, which helps regulate issues related to consumer protection. And so I would describe all of this system of entities and policies and rules are really just a way for us to enforce and implement laws that exist in a way that that fits the needs of the public.
All right. So application of the laws.
Exactly.
All right. So, I mean, so financial regulation, right? Bank examination, what the Federal Reserve Bank does. Can you dig into that a little bit more now?
Sure, sure. Yeah, so the Fed, like I said, they're really a regulator of banks and other financial institutions. They take a big role in ensuring the what we call the safety and soundness of banks, typically, a commercial bank, although they do other types of regulatory efforts related to savings and loans institutions and bank holding companies. The primary function that we is probably most salient is the Fed's regulation of banks. And so, like I mentioned, that's through the lens of safety and soundness. So almost all chartered banks, so commercial banks that have a charter either with their state or with a national charter, they are required by law to be regulated to ensure that their financial performance and how they're delivering loans and how they're taking deposits complies with laws. And so the Fed checks for compliance with laws, but also checks to make sure that the decision making of the bank, how they're lending, who they're lending to, how they're underwriting loans, all of these things are safe and sound so that they are not done in a way that's going to create risk that could burden the economy, burden other financial institutions. And so really, like I mentioned before, it serves the Fed's, one of the Fed's major main functions, main purposes is to create that stability in financial markets. So I view the Fed's role as preventative, but also responsive to things that might happen.
Right. So I want to get into both the why and the how, but let's talk about the why first. Like why do we even want to talk about the how? And you talked about, if part of this is that there's risk for everybody. In
Mhm.
economics, we talk about this idea of contagion, that if you say have enough bad loans or financial stress, it doesn't just affect us individuals, it can affect everybody. Can you dig into that a little bit more?
Sure, yeah. And I often think about that as a distinction between something that's systemic or something that might be acute. So yeah, the contagion that we've probably heard throughout history several examples of contagion in financial markets. The global financial crisis of 2008 is probably something that pretty much everyone's aware of. We had this circumstance where subprime mortgage loans, so loans that were given to borrowers that didn't have the capacity to repay them, were packaged together and pooled into these securitized debt vehicles, and they were sent out throughout the economy, throughout the world, actually. And everyone was exposed to this. So it was a systemic risk that we were lending to a lot of borrowers who didn't have the capacity to repay, and then we were giving everybody a piece of that pie. So it was systemic. And so those are the sorts of things that, very broadly speaking, that financial regulation like bank examination is one of the things that it's trying to identify and trying to help stop, I guess. So regulators are looking for things that could be systemic, and those things that it can come from a lot of different sources. Like I mentioned, it could be something that a lot of different entities are engaging in, or it could be something that's happening in the economy that's external. That could also be a systemic risk for banks. But in general, those are risky because they have really severe circumstances. Oftentimes, it means that a large share of financial institutions, banks, if they're all exposed to the same thing and that one thing happens, then it can have severe circumstances for people who borrow money from those institutions, people who save money with those institutions. So identifying and helping monitor for systemic risks is very important for financial regulation.
Right, right. And I think, a good example for agriculture was probably the 1980s farm crisis. We could talk at length about it, but you had lower farm incomes were lowering, you had inflation, you had high interest rates, you had farms being highly leveraged. And one
Yeah,
consequence of all this is that farmland markets, I mean, that's the last time we've really seen farmland markets go down. And that affected the balance sheet or the wealth of everybody, agriculture.
yeah, exactly. That would be, I would say it's a perfect example that applies directly to agriculture. During that time, you actually had a large number of banks who had a really high percentage of their loans and lending was in agriculture. And so you had uh, a systemic risk exposed to agriculture. And so, yeah, it was right. It was a combination of low commodity prices, and I think even somehow drought at the same time. Folks were somehow had a lot
There was
less
a drought in
production
there,
and prices were
definitely.
lower. It
Yeah.
was the perfect storm,
Yeah.
and the collateral that banks had used to protect themselves from these loans in farmland declined. And so you had huge numbers of sales of land and huge defaults on a lot of agricultural loans. And it actually led to a very large number of bank closures because they had so much exposure to ag
Mhm.
and it was so broad that these banks couldn't sustain the losses and they had to close. That's actually something that is monitored very closely. That sort of changed how we think about that. Did bring about a lot of changes, obviously, just thinking through, even outside of commercial banks, like through the changes in the farm credit system and establishment of programs. But it also informed how agricultural banks, so banks that have concentrations in agricultural lending, are regulated today. And there are actually specific, we call them policy letters. There's a specific policy letter that regulators use as a way to guide their assessment of agricultural banks' lending practices. And a lot of that is to do with how exposed are you to agricultural lending? What share of your loans are agriculture, and what share of your capital is coming from agricultural loans? And how are you making sure that if there is something systemic happening in the agricultural economy, that you're protected? So are you increasing your capital buffer? Or do you have practices in place to make sure that you can help borrowers repay loans if times get tough? And so that definitely informed how we regulate agricultural banks for sure.
Right. And so, one thing we talk about in my department or the agricultural finance profession is that there's some threshold, let's say, of distress sales of farmland. So if you have enough farms that are, having a hard enough time, they have to sell farmland, that's when it could trigger something systemic. And I think, that number, I don't know if there's a precise number, but we've talked about 5 or 6%. And I'm curious if that's in line with what you guys are thinking, that 5 or 6% is a lot, but it's maybe smaller than some people think in terms of the need for this oversight.
Sure. I don't know if I've ever really tried to quantify the exact share of farmland that might be selling, but I do think, yeah, there probably is a threshold where there wouldn't be enough demand to meet the supply of land coming on the market. So obviously, a lot of things have to happen before that. We get to that point.
Absolutely.
On the supply side of land on the market, you have to have enough borrowers who are needing to sell enough land that it creates a supply that does not match what people are able to buy. I would say even in the last downturn in the ag economy, 2016 to 2019 period, 2015, 2019, we were starting to ask, was there going to be downward pressure on land values? Because we were entering this environment where farm incomes were low, and if that goes on for long enough, you might have to sell some land to making your payment.
Yeah.
I actually didn't see a lot of downward pressure at that
Yeah.
time because
Yeah.
there were still enough buyers. There were still people
Right.
that had the cash or the capacity to borrow money to buy land. And I'd say we're still we're sort of entering this period where we're going on 2-3 years now where farm incomes are lower, profit margins for crops are a little bit strained, and we haven't really seen in the farmland markets, in general, there might be pockets where there's a little bit more weakness, but in general, demand and supply are still pretty balanced. In most
Right.
cases, in most areas, there's still an adequate number of buyers for land that's coming on the market.
Yeah. Yeah. Not trying to be alarmist. I
Yeah,
think there are several things that would have to happen
of
for
course.
that mismatch. But from a pure economics perspective, if farmland prices were going up right now with our current crop profit margins, that would mean the market wasn't accounting for these underlying fundamentals. It's like, well, if prices are flat or going down a little bit, that might reflect crop prices, but that's different than what you're looking for, is if there's, a lot of stress.
Exactly. Really those signals that there is a mismatch, maybe land is sitting on the market longer. And even now we do hear anecdotes, we collect a lot of information from agricultural lenders, and we often ask about the number of land sales or the share of borrowers who are needing to maybe sell assets to help their balance sheets and to help make sure they have enough cash to operate and they can repay their loans. And although we've seen some increases in those instances where farms might be selling a tractor, they might be selling a parcel of land, it hasn't been a substantial increase. And so yeah, we definitely we definitely are though monitoring for signs that is that picking up, is that changing? Because I do think back to your original question on this topic, I think there probably is a threshold where it would start to put a lot of downward pressure on land values for sure.
Yeah. All right. So let's pivot to what this looks, how people experience this sort of, the application of these laws, the regulation of lenders. I'm curious, what is the experience like both from employees of banks as well as producers or small business owners? How would they experience the application of these laws?
Sure. I'll maybe start from the bank perspective. So for commercial banks, they if they if they're a sound institution and their financials are well rated and their management practices are well rated, they're getting they're getting an examination so on a regular basis, and it's typically it's typically like a 1.5 to 3 year time frame is typically what banks are on that base. Periodically they have a team of examiners are coming into the bank, and they are, like I said, they're assessing their financials, they're assessing their management practices, they're assessing their policies. And so from a bank customer's perspective, you probably wouldn't know that was happening. You also wouldn't know that there's also a lot of things that banks are required to do even when examiners are not there. So reporting to what we call the call report. So every quarter, the bank has to take a snapshot of their financial situation and submit it. And every bank has to do that. And so that allows regulators to assess the condition of the finances of the bank without actually going in there. There are also just a lot of other things that banks are doing, a lot of rules to be able to lend and to be able to take money. And so I would say bank employees are interacting with regulation and policy on a daily basis. And then they're on a 2 to 3 year basis, it's a little bit heavier where they're getting a more thorough assessment. For customers, so think like agricultural producers, they're probably getting elements of their interaction with regulation when they're going through an underwriting process for their loan. So like I said, banks are sort of always being assessed on how well they lend and who they're lending to and their standards for lending. And those are often reflected in the types of documents or the types of information or the types of financial expectations that banks place on their borrowers. And so I would say that's probably how producers are most directly affected by regulation, is through the types of underwriting standards that banks place on them. The other avenue would be through deposits. So all banks are required to hold deposit insurance that makes sure that if banks aren't able to provide the amount of cash that borrowers need, that it's protected by the FDIC. And so that's another thing that banks are required to hold. So it protects depositors' money. And so that was probably be another direct way that producers are interacting with regulation.
So it's you might not notice it on the individual level too much unless there's a change in rules or
yeah, exactly.
Mm-hmm.
Yeah, it's definitely more indirect for producers. Like I mentioned, banks, it's something they think about daily. It's something that they have to incorporate into their policies and their practices. And so for them, it's a little bit more consistent.
Yeah. And we've talked about things that can go wrong. We talked about the farm crisis. We talked about the Great Recession in 2008. Could you give examples of when financial regulation, when the process works well?
Sure. I might just say every time that we don't have a crisis, we know that it's working. So I would say that there's obviously always risk that something that we don't know about is going to happen. So, I mean, if everyone would have known that the financial crisis was going to happen, we wouldn't have let it happen. If everyone would have known the farm crisis in the 80s was going to happen, we wouldn't let it happen. Those are more instances of when we learned that we needed new types of regulation, new types of policy. I would say we know that regulation is working when we have financial stability, when we have economic stability. I would say that is a good sign that regulation is functioning the way it should. And I would say that's one sign. And then the other sign, if that's happening, along with great access to credit. So adequate access to credit. Yep. So if we're able to provide all of the credit that the economy needs, and we're also able to have financial institutions that are sound and they're financially strong, then if those two things are happening together, from my perspective, I think that means that financial regulation is working.
Right. And I think you kind of alluded there, access to credit. And so, as a part of our economy, I think, especially in the US, like we want people to take risks to some degree, that there's some risk reward trade-off, or that, people are able to do that. So, I mean, banks do have to balance like letting borrowers take risks versus the other sort of broader risk to the entire economy.
Yes, correct. I think it's a constant balance. Yeah, banks are balancing risks in the economy. They're balancing policy and regulation with running a business because banks are a business. They are trying to make money. They have to make money. So they're trying to balance a lot of things. And so, like I said, that's why I think when they're able to provide credit that borrowers need in agriculture, and we do tend to think that credit availability in agriculture, for the most part, there are segments of the agricultural economy that might be underserved in terms of credit access, and those are sort of acute issues. But in general, the credit access in agriculture, I would say, is adequate for the farm economy to operate. Obviously, when we have different economic circumstances that affects the amount of credit or the type of credit that borrowers need. But in general, I think the agricultural credit system does a good job of providing credit to borrowers in a way that allows banks to take a little risk without too much risk, and it allows borrowers to take and producers to take risk without taking too much risk.
Right, absolutely. And I have heard, I think we talked about this separately, but right now we have tight profit margins for crops in a lot of areas, and you do get stories that some producers haven't had their lines of credit
Sure.
renewed. I'm sure that you all are seeing this too.
Yeah, so it is when we're at a turning point in the ag economy, it does become challenging for some lenders to be able to lend in the same way, especially when they're trying to protect their risk. Sometimes what we see is there might be lenders who may not be totally specialized in ag. Maybe they just lend in agriculture when times are good because
Yep.
it's an easier thing to do. There might be someone in the local community that needs a loan, a farmer. And then during times where it gets a little bit tighter and it might be a little bit harder to figure out how to get borrowers on a good path in terms of their debt repayment, some banks might not be able to do that in the correct way that could help borrowers. And so we do
Right.
sometimes hear anecdotes that individual banks might pull back a bit on their lending. But in other cases, we have banks that specialize in agricultural lending. They know how to structure loans during times of stress to help borrowers, and they know how to do as much as they can to get borrowers through tough times. And so, yeah, I think we have heard, individual anecdotes of maybe some types of lenders or some types of borrowers that may be having a little bit harder time getting the same type of credit. But I think there are a lot of different options in agriculture. So there's
Absolutely.
commercial banks, what we're talking about, but then there's also government programs and government entities that help borrowers who might not be able to get that type of credit. So the Farm Service Agency and the farm loan programs of the USDA are a great example. That program and those loans are really meant for borrowers who may not be able to acquire credit from other institutions like banks or the farm credit system. So there's sort of a backstop for when farms may not be able to access credit through the channel that they want. There's a lot of other channels to get credit.
Right, absolutely. And we did see the Farm Service Agency I think it was a Farmers Home Administration back then, but in the 80s, they took on a bigger role and then it declined. I think today they work a lot with beginning farmers or farmers that might not have built up enough collateral. So you definitely see that. Well, all right. Is there any other topics related to sort of regulation of banks, how it affects agriculture, what the process looks like that you think we didn't cover or you'd like to talk about more?
I might just mention a little bit of what we're observing and what we monitor. So like I mentioned, we have a lot of efforts to monitor conditions in agricultural credit. So we have several surveys that we send to lenders on a quarterly basis, and we have several data products that we produce here at the Kansas City Fed to help us track conditions. And we have noticed that a lot of indicators of agricultural credit are tightening a bit. I would say a lot of it is driven by low profits for crop producers. But at the same time, we've seen that a lot of the strength that was built up a couple years ago, I think 21, 22, is really helping a lot of producers right now. So their balance sheets were very strong, and we're sort of weathering the storm right now in terms of agricultural credit conditions. We've seen some tightening, but we haven't seen a high level of financial stress in agriculture. That doesn't mean that there aren't maybe pockets or individual producers or groups of producers that might be more challenged. I think probably new and beginning operations, which are typically more highly leveraged, is it could be a very challenging time. We also talked about farm real estate values and how they've been holding firm, and that's a source of support when you're talking about credit, because you can use that as collateral to get the size of your loan payments down and sort of extend things out. If you don't have access to that, let's say you're a majority renter or you rent all your ground, things could be a little bit more challenging in a circumstance like this. So definitely probably some pockets where things are a little bit more stressful, but in aggregate, we haven't noticed a high level of systemic financial stress in agriculture. But we monitor on a regular basis for signs that things might be changing. So it's definitely something we're paying attention to. I like to describe our work at the Fed as equal parts listening and sharing. So we listen to a variety of different constituents through surveys and through outreach. And then we use that to inform what we do with our research so that we can inform other people. We really do think of ourselves as a connection, like I said before, a connection to the central bank to help inform the policymaking process, but just to help keep people informed about conditions in agriculture.
Right. So as we wrap up here, I kind of want to dig into, should people care? So if you work for an agribusiness, if you work in ag retail, if you're a producer, I think, lenders, loan officers, they're dealing with it on a daily basis. But for other folks, is this something you should care or something that you should worry about?
I absolutely think that everyone should care about financial regulation. Like I said, the purpose is to create economic stability and financial stability. And things just run more smoothly when there's stability, when you can be more certain that credit is going to be there, you can be more certain that a bank is going to be there. And so financial regulation helps make that happen. It helps make sure that we're balancing the risks of lending and borrowing with the need to provide credit to the economy. That balance is important. I think we're probably always adjusting that balance. What is the right balance of regulation to make sure that all of those things are happening? But in general, I think it's a very important element that helps our economy function in a way that everyone can benefit.
And I guess you could also say if it's working well, it's in the background and people can go about their business, they can make investments and maybe not even have to think about it very much.
Exactly. That is the ideal world where regulation, you don't even know it exists.
All right. Well, Ty, thank you so much for the time.
I've really enjoyed being on, Jenny, and thanks for the great discussion.
Yeah. Thanks for joining us on this episode of Smoke and Mirrors. If today made you think or see things a little differently, share it with someone who appreciates cutting through the noise. Don't forget to subscribe, rate, and leave a review wherever you get your podcasts. Thanks for spending part of the day with us. Until next time, keep asking what matters.